In 2009, the financial world looked broken. Banks were collapsing, retirement accounts had been cut in half, headlines sounded apocalyptic, and most people were doing what fear always tells people to do: wait, hide, freeze. But one school teacher did something that looked insane. She took money she'd been saving for a house down payment and invested it into a boring S&P 500 index fund, at the exact moment when everyone else was convinced the world was ending. Today, that decision is worth hundreds of thousands of dollars more than the cash she kept would have been. That's how wealth usually gets built. Not through secret stock tips, not through brilliance, not through perfect timing, but through recognizing when fear blinds everyone else to what's actually happening. And that matters right now, because most people think the next great wealth building opportunity will look like a market crash or some dramatic headline event. Something obvious, something cinematic, something everyone will point to afterward and say, that was the moment. But the biggest wealth opportunities often don't feel dramatic while they're happening. They feel boring. They feel gradual. They feel easy to ignore. And that's exactly what's happening now. There is $124 trillion moving through the American economy over the next 2 decades. That number is so large it barely sounds real. But it is real, and most people have no idea what it means, how it works, or why it may become the single largest wealth-building tailwind ordinary people will ever see in their lifetime. This is not about getting rich from inheritance. This is not about hoping your parents leave you a house. This is much bigger than that. This is about what happens when an entire generation begins handing off the largest concentration of private wealth in human history, and what that movement of money does to markets, real estate, businesses, financial services, and every ordinary person who is positioned well enough to benefit from it. The people who understand that early will spend the next 20 years building quietly. The people who ignore it will look back in 2045 and wonder how so many people around them got ahead while they stayed financially stuck. Let's start with what happened after 2009 because it explains almost everything. Most people remember the panic. They remember Lehman Brothers. They remember the fear. They remember 401ks getting destroyed and headlines comparing the crisis to the Great Depression. What most people don't remember is what came next. From the bottom in 2009 to the beginning of 2026, the U.S. stock market didn't just recover, it exploded. The S&P 500 rose more than 900%. $100 turned into roughly $1,000. But the people who benefited most weren't hedge fund managers or Wall Street insiders. They were ordinary workers who kept buying through their retirement accounts. Teachers, nurses, accountants, engineers, small business owners, people who didn't know everything, they just stayed in the game. That's one of the most underappreciated truths in wealth building. The biggest fortunes aren't always made by being smarter than everyone else. They're often made by being positioned while everyone else is distracted or afraid. And the numbers prove it. In the early 2000s, the United States had a little over 8 million millionaire households. By the end of 2024, that number was close to 24 million. In other words, the country created roughly 15 million new millionaire households in a little over a decade. That is a staggering number. It means an enormous share of wealth creation in America happened not through dramatic startup exits or lottery-like events, but through long periods of asset appreciation combined with consistent participation in the market. And that is exactly why the moment we're entering now matters so much, because another giant tailwind is forming, and this one may be even more powerful than 2009. What's happening now is called the Great Wealth Transfer. But that phrase is too soft for what it actually describes. It sounds like a technical planning topic for estate attorneys. In reality, it is a giant economic event. Between now and roughly the late 2040s, an estimated $124 trillion in wealth is expected to change hands in the United States alone. That means homes, investment accounts, business ownership, cash, bonds, stock portfolios, and property accumulated over decades will start moving out of the hands of older Americans and into the hands of surviving spouses, children, grandchildren, charities, and the broader divided chancellors. That number is difficult to understand, so here is the important part. You do not need to personally inherit a fortune to benefit from this. You just need to understand what happens when that much money begins moving. When money moves, it doesn't stay still. It gets reinvested, it gets spent, it gets reallocated, it gets sold and bought again. It flows into brokerage accounts, private businesses, real estate, financial products, new portfolios, new priorities, new geographic markets, and entirely new categories of demand. That movement creates opportunity everywhere, and that is the part most people are missing. They hear wealth transfer and think, this only matters if my family is rich. That's the wrong frame. The opportunity is not just the inheritance itself. The opportunity is the economic wave created by the movement of that money. Imagine what happens when trillions of dollars leave one generation and enter another generation with different preferences, different spending habits, different investment beliefs, and different timelines. Some of that money goes into markets, some goes into housing, some goes into business, some gets spent, some gets donated, some gets mismanaged, some gets parked, some gets redistributed into entirely different sectors and regions. And every one of those flows creates winners, people positioned in the right assets, right industries, right businesses, right professions, and right locations capture part of that movement, even if they never directly inherit a dollar. This is why the current moment matters so much. It is not just a transfer of wealth, it is a transfer of demand, a transfer of capital, and a transfer of economic gravity. And when that happens at a scale this large, it changes everything. Now here's what makes this even more powerful. The wealth isn't moving out of a weak generation, it's moving out of the wealthiest generation in American history. Baby boomers control an enormous share of U.S. wealth. They benefited from decades of home appreciation, post-war growth, strong stock market returns, and a long period where asset ownership was enough to produce serious financial gains. Now they are aging, and over the next 2 decades, that accumulated capital begins to leave their hands. Some of it will first move to surviving spouses. Some of it will move directly to children and grandchildren. Some will go to charities. But regardless of the route, the capital moves. And as it moves, it reshapes the economy. Gen X will receive part of it. Millennials will receive an even larger share over time. Gen Z will increasingly enter the picture later on. That timing matters because each generation is likely to do different things with the assets they receive. Older generations tended to prefer traditional blue-chip stocks, bonds, and stable real estate. Younger generations are much more likely to direct capital toward index funds, technology, healthcare innovation, digital platforms, AI infrastructure, alternative assets, and newer forms of investment participation. Even when people don't realize it, that shift in preferences changes which sectors attract the most capital over the next 20 years. And where capital flows, prices tend to follow. That means the great wealth transfer is not just a family event. It is a market event. It is a housing event. It is a business event. It is a labor market event. It is a financial services event. It is an everything event. And if you understand that, you stop looking at it like an interesting demographic trend and start seeing it for what it really is, a rare, slow-moving wealth machine. Here's where people go wrong. They assume opportunities like this are only for people who already have money, but history says the opposite. The people who benefited most after 2009 were often not wealthy when the opportunity appeared. They were ordinary investors who kept buying, ordinary workers who stayed exposed, ordinary savers who let time and markets do the heavy lifting. The same principle applies now. You don't need to be rich, you need to be positioned. So what does positioning actually look like? First, it means staying connected to broad asset growth. If trillions of dollars are going to keep moving into and through markets over the next 2 decades, you want exposure to the markets that capture that movement. For most people, this still means boring index-based investing. Regular contributions, low fees, long time horizon, no drama. Wealth transfer tailwinds are powerful, but they still reward the same basic behavior. Consistent ownership of productive assets. Second, it means understanding that younger generations will pull money toward different sectors. You do not need to make wild bets on every trend, but you should understand that large capital flows toward AI infrastructure, health innovation, digital finance, and next generation businesses are not random. They're part of a broader generational shift in where money wants to go. Capital is never neutral, it follows belief, and younger investors believe in different things than their parents did. Third, it means paying close attention to real estate, but not blindly. Real estate will not rise evenly. Some markets will face heavy supply from inherited properties coming to market. Others will face stronger demand from younger buyers with access to transferred wealth. Some areas will stagnate, some will intensify. The point is not to assume all real estate wins equally. The point is to understand that when wealth moves, location matters even more. Fourth, it means recognizing that entire professions will benefit from the transfer itself. Financial planning, estate administration, tax strategy, trust services, real estate services, wealth advisory, business succession planning, any field connected to helping people receive, protect, deploy, or manage moving capital is going to live inside one of the largest financial shifts in modern history. The people who build expertise in those areas may find themselves standing in the path of an enormous amount of economic activity. Fifth, and this is critical, it means refusing to wait for a perfect moment. This is where people always sabotage themselves. They want the ideal entry point. They want certainty. They want some dramatic confirmation that the opportunity is real. But wealth building events almost never announce themselves clearly in real time. In 2009, no one knew the exact bottom when it happened. If you had waited for certainty, you would have waited too long. This moment works the same way. There is no bell ringing to announce the great wealth transfer has started. It is already happening. The oldest boomers are already late in life. Assets are already shifting. Capital is already moving. And every year you stay on the sidelines is a year compounding works for someone else instead of for you. There's another reason this matters. Wealth creation events rarely feel like wealth creation while you're living through them. After 2009, the market kept producing reasons to be afraid. European debt problems, government shutdowns, trade wars, pandemic crashes, bear markets, inflation scares, rate hikes, and yet the long-term trend kept rewarding people who stayed invested. That is how major wealth periods usually work. They do not feel calm. They do not feel obvious. They feel noisy, uncertain, and easy to mistrust. But underneath the noise, capital continues doing what capital does. It moves, seeks return, concentrates around productive assets, and rewards participation. So what should an ordinary person actually do with this? Start with the basics and stop underestimating how powerful they are. Max out tax advantage accounts wherever possible. Employer retirement plans, individual retirement accounts, health savings accounts if you qualify. These are not boring side details. They are the containers where long-term wealth compounds with the least friction. Then, stay exposed to broad markets through diversified, low-cost funds. Stop waiting for a once-in-a-lifetime crash to begin. The transfer itself is the long tailwind. Build liquidity too, not because cash is the goal, but because dislocations will appear during a 20-year transfer wave. There will be estate sales, market drawdowns, local real estate softness, and moments when having available capital matters. Hold enough cash to survive and to act. Don't become obsessed with finding the one perfect sector or the one magic stock. The point is not prediction. The point is positioning. If younger generations pull more money towards certain themes over time, you'll likely capture part of that through broad ownership anyway. The bigger mistake is being absent, not being imperfect. And most importantly, extend your horizon. This is not a one-year opportunity. It is not even a 5-year opportunity. It is a 20-plus year wave. That means patience wins. People who think in headlines will miss it. People who think in decades will benefit from it the most. Here's what I find most fascinating about moments like this. The information is public. The data exists. The reports are available, the trend is visible, and yet most people still won't act. Not because they can't, but because the event doesn't feel urgent enough. It's not a crash. It's not a meme stock. It's not a dramatic overnight story. It's just a massive amount of money quietly moving in a way that will reshape the next 2 decades. That's exactly why it matters so much. It is easy to ignore right up until the results become obvious. Then people will pretend it was inevitable, just like they did after 2009. But the people who actually build wealth during periods like this are not the ones who explain it best afterward. They are the ones who positioned while it still felt easy to dismiss. So if you zoom out, this is what you see. After 2009, the market created millions of new millionaires because ordinary people stayed exposed during a long period of recovery and expansion. Now we are entering a different but equally important phase. Not a recovery from collapse, but a generational redirection of capital on a historic scale. $124 trillion moving through families, markets, businesses, and institutions over 20 years. That does not guarantee easy wealth, but it absolutely creates a rare environment where steady participation can become much more powerful than usual. And that is the real message here. You do not need a perfect inheritance. You do not need rich parents. You do not need inside information. You need awareness, positioning, patience, and the willingness to act before the rest of the world starts talking about it like it was obvious all along. If this changed the way you think about the next 20 years, like the video and subscribe. And tell me in the comments what you think will capture the most wealth from this transfer. Stocks, real estate, businesses, or something else. Because whether people notice it or not, the largest wealth shift in modern history is already underway. And the only real question is whether you'll spend the next 2 decades watching it happen or benefiting from it.